This is a FarmDoc Daily webinar. I'm University of Illinois Extension's Todd Gleason. I'll moderate the program for the day. Thank you for being with us today. We'll talk about the grain market outlook for 2023. This is part of the Illinois Farm Economics series. This one we call IFES Online, or the Illinois Farm Economics Summits Online. We're joined by Scott Irwin and Joe Janzen to take a look at the numbers, and they'll walk us through the changes from USDA and what their considerations are for the 2023-24 growing season. Gentlemen, good morning to you. Thanks for being with us today.
Thank you, Todd. Good to be here.
Good morning.
So Joe or Scott, I actually forgot to ask, which one of you are starting today?
I'll kick us off. I just want to, again, mention this is something very similar to the material that we presented last week when we were on the road in Mount Vernon, Peoria, and DeKalb, trying to get out into the state. Obviously, we've had things change in the grain markets. The one great thing is that there's always something new to talk about and discuss. This is kind of our sort of forward-looking attempt at a forward-looking grain market outlook. I mean, in a period when the stakes are relatively high, we have cash corn prices with a number that's in the high sixes, something around 675, 680 right now. We have still something close to $15 soybeans. So I think the one thing that we can say is that the stakes for the grain markets are very high in a year like this year. And so what we want to do is just identify some of the factors that are relevant to prices, kind of discuss how they fit into the overall supply and demand picture using the balance sheet, and discuss how farmers might respond. I mean, one thing that that came out of the meetings last week was that we still have a marketing challenge at the farm level in terms of marketing the crop that we harvested in 2022. There's still lots of old crop grain that needs to be priced. And then obviously, we have a crop that we're going to plant in 2023. We're going to talk a little bit about planting prospects and sort of what planted acreage might look like going forward. And we'll kind of sort of bounce some ideas off of each other here as we go forward. Before we get too far into our outlook, we want to kind of go back and think about what happened in the last year. We know that history doesn't sort of repeat itself directly, but there are probably some of the things that were major forces in the grain markets in 2022 that might also be significant factors in 2023. So we can take a little bit of a reminiscence here. What happened in 2022? We started the year with corn and soybean prices that we thought were pretty good. Prices, corn prices in the fives, soybean prices around say $13, $14 a bushel. Those were pretty good price levels. And there were a bunch of things that happened that really no one saw coming. The first one really hit the soybean market in early mid-January, continued through that month when we got sort of some news about South America's corn and soybean crop, particularly that soybean crop out of Brazil and Argentina coming in much smaller than would be initially expected. That lit a fire under the soybean market. Also some strength in corn, but the real big rally in corn happened in late February. We have sort of probably the biggest news, the biggest sort of unexpected thing in 2022 was obviously the Russian invasion of Ukraine. That really kind of moved us into a bit of a new paradigm where we thought there was significant supplies of grain, particularly wheat and corn, in a part of the world where that grain couldn't get to the final end user. Russia and Ukraine, both massive grain exporters, and the thought was that a significant amount of their production would be curtailed, and then existing inventories would be tied up in that part of the world. That got us to $750-ish old crop corn prices. Obviously, the prospects for new crop were sort of diminished. We know that when the market has some time to build some supply response, we think that the market, that suppliers will respond in other parts of the world. So that new crop prices, the lower lines in both of these graphs, were at lower levels than old crop prices. So that new crop, old crop inverse has been kind of with us this whole time. It continues to this day. Coming out of that period where we had the Russian invasion of Ukraine, we see prices really fall back going into the summer months. In part, the biggest sort of news story there was the Russia-Ukraine grain deal. that would allow for maritime exports from Ukraine. So we had all that grain tied up in Ukraine. Some of it was trying to move by other means, by rail and truck outside of the country. But really, they can't move that crop without the ability to export through the Black Sea. That happened. And just generally speaking, the sense was that the supply and demand situation, the ability of grain to flow around the world, that some of that supply chain tightness was being relaxed. We saw prices move lower. And then kind of coming into the harvest period, especially for corn, we saw that U.S. yield prospects were significantly lower than what was initially what our initial expectations were, and that kind of brought us to corn prices in and around that $7 range. We've kind of been somewhere in that $6.50 to $7 range ever since. The last sort of piece of news here was really at the end of the year, we've seen some news about South America and about the South American crop prospects, really kind of lending support to old crop soybean prices. So you can see on the far right of this slide, just this divergence between old crop and new crop soybean prices. Lots of strength in the old crop, less so in the new crop. And that's really about sort of like, can we maintain product flow through the remainder of this crop year till we get a crop from South America. So that's been kind of something that's providing strength, really sort of especially on the soybean side. So then sort of putting this all together, we want to think about, well, where do markets go from here? What might be sort of major supply and demand news that could kind of change the current situation, which is, again, to be very clear, historically high price levels going into sort of the back half of the old crop marketing period. One other thing we want to mention is on just sort of talk through what happened in the wheat market. We were down in Mount Vernon in southern Illinois, where wheat production is a much bigger deal. We saw USDA come out with their winter wheat seedings report that showed pretty strong an increase in winter wheat seedings in the country as a whole, and really talk about the sort of the wild ride that wheat prices have been on over the course of 2022, and maybe how that a little bit relates to the corn and soybean marketing situation. Obviously, the big story here is, again, that war in Russia and Ukraine that really kicked off a pretty strong rally where prices nearly doubled over the course of the first 6 months of 2022, peaking in June. And that's a pretty rare scenario, right? When we see winter wheat prices peaking right around harvest time. Since then, with the Russia-Ukraine grain deal, and just sort of a general sense that the wheat supply and demand situation is not as tight as people might have initially feared, we've given back pretty much all of that rally through the remaining back half of 2022. The world one thing, realizing that the world doesn't need U.S. wheat in the same way that it needs corn and soybeans. So if anything, it's supply and demand news for corn and beans that's kind of leading the way. There's not a lot of support from sort of outside ag markets. We're seeing wheat prices down back in relatively sort of average levels, somewhere in that $7 range. And with the prospect of large crops in other parts of the world. So the other thing about the wheat market is wheat production's dispersed all around the world. We've seen good crop news coming out of Australia, and then lots of other places where we can draw wheat. The supply and demand situation for wheat is not as tight. There's not sort of, I think, a reason to believe that wheat market will kind of have any influence on corn and beans. That gets us to our old crop corn balance sheet for 2022-23. I'll have Scott sort of talk us through a couple of the numbers in this balance sheet, things that we see as being important. Remember, the balance sheet is just kind of our attempt to provide a complete or a relatively complete accounting of what does the supply and demand situation look like overall, and what are some of the major factors that determine whether corn is abundant or scarce going forward.
Yeah, sounds great. I just was going to add one comment on the wheat price chart. The the perspective there is, Joe, it's pretty remarkable to see that $5 a bushel drop in the face of an ongoing, very severe drought in the Great Plains wheat growing area of the United States, and no let up in the war, although there is the shipping agreement, which is important. But even nonetheless, compared to the fears that existed, say, in April and May, and it's a great lesson that we had really more wheat around than the rhetoric, and the market did its job. And I'm glad to see that happened. And we didn't need to take some extraordinary measures like I was getting people to think about last spring. So it worked.
And I think the lesson going forward is like we should anticipate supply response for all commodities when we in the face of high prices like this. And so when I think about where does that come from, maybe on the corn and soybean market, and we'll kind of talk a little bit about that.
Definitely something we're going to be talking about here. Going the first number to highlight from the January crop production annual summary was a very large, by historical standards, drop in the harvested acres for the 22 crop. It dropped 1.6 million acres between November estimate and January. So we had that drop, and we did have a corresponding 1 bushel increase in the yield per acre, so that the impact on the corn market wasn't as severe as you might think with a 1.6 million acre drop. Production dropped by about 200 million bushels, so that we did have a little less supply than we anticipated before the January numbers came out. And so you can see that our numbers, the farmdoc 22-23 numbers are exactly the same as what the USDA is carrying on their latest WASDE forecast.
Yeah, certainly something we didn't see coming, I think, was that change. I mean, the trade was expecting a minor tenth of 100,000 acre change, and we saw 1.6 million. But at the same time, I don't think there's anything that sort of leads us to believe that USDA's numbers aren't sort of. I mean, I think there's a sound basis for it based on what happened, particularly in the Western Corn Belt with dryness in that part of the world.
I can anticipate probably already getting this question. Part of the explanation is that the December 1st ag survey that the USDA uses is a dramatically larger survey than any of the individual crop production months. And so it was one of those things that out in the Great Plains, there was clearly a lot more abandoned acreage than they had picked up in their earlier surveys, and there was nothing nefarious going on. It just wasn't picked up until you got a really larger sample size like they have for that December survey. So that's, I think, is the explanation. And almost all the loss was out in the Great Plains due to the severe drought and abandoned acreage. So the really also equally interesting news going on with the on the use side, a lot of interesting things going on. The USDA in their January WASDE numbers actually lowered, Joe, the feed and residual number by 25 million bushels. And you'll see that we are actually arguing that we should increase it 50 million bushels above the USDA's Jan number, and actually an increase over and above where it was in the December WASDE. And I'll jump down here to where that comes from. This is the implied usage surprise for corn in that DEES-1 grain stocks report. So this takes into account the difference between what the market expected for first quarter marketing year total usage of corn after we have to adjust for the smaller corn crop. So you have to take that 200 million bushels into account. And basically, it said that total usage of corn in the first quarter was 141 million bushels larger than what the trade was expecting. And And just kind of a rule of thumb, the way Joe and I approach this is that roughly speaking, there's a lot of variation quarter to quarter. So you kind of fade that in your estimates by half. So you could look at that 141 bushels and say, you would raise your feed and residual by 70 million, would be kind of the ordinary procedure. But this is a pretty unusual situation where the USDA chose to go down in the face of that bullish supply data point. And we're going to stick with the data. And that's why we're raising our feed and residual estimate compared to the USDA by 50 million. So that's what's going on there.
Yeah, it seemed like USDA in the report really wanted to kind of figure out, how can we account for this, how can we account for this change in production, and sort of, does that mean we need to back things off a little bit? And so that was part of maybe part of their logic. But at the same time, I think we're going to be closely watching what does the drawdown in stocks look like from DC1 to March 1st. And does that sort of back up this story that maybe feed and residual use is a little bit stronger?
Right. USDA is obviously, like you said, in the past, this is very unusual for them to lower feed and residual use in the face of that kind of bullish information. And so we are keeping ours really cautious compared to the size of that surprise, and definitely something we want to really watch carefully going forward, particularly with possible macroeconomic recessionary trends. Maybe this is just a statistical blip. We'll find out.
Walking through the corn usage side, we want to talk a little bit about ethanol use. USDA kept their ethanol number at 5.275 billion bushels. That number's kind of been pretty sticky in the USDA's corn balance sheet going forward. We see maybe some reason for weakness, a little bit lower ethanol use than what USDA is projecting, basically on the basis of what we see in terms of gasoline use, Scott.
Right. This chart is a measure of weekly gasoline use in the United States, and the most important comparison is to look at that green 2022 versus the dark, thick black 2021. And we were tracking pretty closely through the first half of the year. And then crude oil and gasoline prices spiked. The economy started to slow down. And you can see a very substantial gap opened up between the 22 and 21. Since September, that's averaged about 6.5% lower for 2022. Now, this is a very noisy indicator, and we really rely on the monthly estimates because they are based on a larger survey from the EIA. And the latest number we have is for October for those monthly surveys, and that is down. That was down 2%. So, that leads us to be a little bit more bearish than the USDA. The USDA at 52.75 is only down 1% for the year. So we're going to drop it another 50 million, which is basically down 2% for the year. And I think that's another thing that's pretty interesting in the face of that bullish surprise on the stocks number. We'll have to kind of see the push and pull there, which one's going to be right, because the gasoline data is really looking pretty bearish for the ethanol number going forward.
Right. The last thing we want to talk about here on the corn balance sheet is the export picture. We've seen in the January report, USDA lowered their projections for exports by 150 million bushels. That's a pretty significant move on top of prior moves that, just as a bit of context, we were discussing how USDA started this marketing year, their estimates for this marketing year, at a roughly sort of unchanged level, 24 or 2.4 billion bushels of corn exports from the United States. We're down in using USDA's number at 1925. But looking at the export pace to date, you'd have to say, Scott, that there's, possible further weakness. I mean, these numbers sort of continue to disappoint.
That's an ugly chart, Joe.
This is not the chart that you'd want to use if you were trying to convince me that the corn export market is hot. We've seen that orange line that represents our export pace this year, both sales that we've made and committed sales that are on the books up until the beginning of January here has just kind of languished. We saw a little bit of a blip up in that orange line in November when we made some pretty large sales to Mexico. But since then, again, the pace has been slow. You could argue some of that is slow movement to export markets due to the shipping issues on the Mississippi River. But I think the story is that a lot of that's largely sort of resolved itself. And if we sort of continue on, certainly on this pace, we're not going to get to USDA's current 1925 number. Even if we pick up the pace, and this is the time of year when we typically do pick up the pace a little bit, you project that forward, it's hard to get to that 1925 number. So in our balance sheet here, we shade USDA's export projections a little bit further down to 1.9 billion bushels.
And I think a point that you've been making in the meetings last week that I think is an important one is, the data we have is that 1900 may be even a little hard to achieve.
Yeah, so I guess the question is, why didn't we change our number a little bit more? I think, again, in forecast, we're cautious forecasters. And I think that this number reflects a little bit of caution. I think you could tell a much more of a doom and gloom story on corn exports specifically.
Right.
Okay, so all of that together puts us to a stocks to use number that's still slightly above what USDA. The net effect of all of those changes, we are getting sort of some conflicting signals on corn use. A stocks to use number that's slightly looser than USDA's 8.9%. We're at 9.1%, but that does kind of put us on a bit of a knife edge going into 2023, where if we rebuild stocks much above this level, we have to think that prices are going to move lower. For old crop, that keeps our season average price at $6.50. But the question is sort of, what does that do to the new crop balance sheet? And we'll discuss that in just a second. For soybeans, I think the story here is that we see maybe less reason to differ from USDA's forecast, Scott.
Exactly. If you look there on the supply side, we lost some acres. The big surprise on soybeans was the drop in the January report was the drop below 50 bushels an acre. That really took people by surprise. Area harvested
dropped a little as well.
A little bit, but the yield drop was the big story on soybeans. We are just sticking on the supply side in soybeans like corn on the old crop. We don't see any reason to differ with the USDA. When you go down to the usage side, exports and crush has got to continue to grow some with the renewable diesel push. There's a lot of people that believe that because of the new plants being built, that it'll be even bigger. But I think that's a pretty good forecast. Exports, kind of, Joe, the opposite situation compared to corn.
USDA in their January WASDE kind of lowered that export number down below 2 billion bushels. And I mean, I think looking just at export pace alone, I do question that decision a little bit. I mean, I think it's, again, sort of balancing the fact that, they also did lower production. And that meant that, that got you to an ending stocks number that was pretty tight, right around that 200 million bushel mark. However, looking at the export sales data, I mean, you'd have to say we're really close to where we need to be. Again, this year is the orange line. Out to the first week of January here, we're above where we were last year, which was a pretty strong year for U.S. soybean exports, well above the pace that in the previous 5 years that would put us right close to that USDA number, right around 2 billion bushels. We don't have far to go here. Even with a large South American soybean crop coming, I think we'd have to think that we can get to where USDA is at.
An important point that you make there that when we have this more optimistic scenario for soybean exports, we're taking into account the typical pattern that when the South American crop comes on, that our sales really tail off. And so even accounting for that, it's been a very good year for soybean exports, and we don't see any reason to alter that.
Right. So in our balance sheet projections, we kind of move that export number back up above 2 billion bushels, recognizing again that even with the South American soybean crop coming to the market here in the next 6 months, export sales have been strong to date. That gets us to an ending stocks number that is below 200 million bushels. That is historically tight. But if you remember back to sort of you don't have to look back too far to see the U.S. soybean ending stocks at a number below 200 million bushels. We were there, I think, almost every year between 2009 and 2016. I think we probably get somewhere close to there again. That puts us at a stocks to use ratio that's about 4%. Again, historically tight, but certainly in line with market conditions as we see them now for old crop pricing, with old crop futures in that above $15 area. So that's the soybean balance sheet. The big thing that we'll be looking at going forward, I think we can spend a little bit of time hanging out here and talking about production prospects from South America. So in this graph, we just show both acreage, the orange line sort of combining acreage in both Brazil and Argentina. And then the bars here showing estimated, historic and estimated production, again, from both of those countries. So you see that Brazil sort of being about 2/3 to 3/4 of supply, and Argentina being the rest. And a lot of the discussion in the last few weeks has focused on weather in Argentina, and what that might do to production prospects. We know that the crop out of that part of the world was pretty short last year, especially for soybeans. You saw a pretty significant decline in soybean production in South America last year, in the 21-22 marketing year. But the forecast is for these things to rebound. I think the danger in this chart, if I can sort of broadly sum it up, Scott, is that you can tell yourself a story that kind of fits your outlook based on the little piece of this chart that you kind of pick out. So I think the number that's, I think, really scary to people, or has been sort of the talk in the trade, is on the far right side of this graph. The blue bar there represents the Argentina soybean production number. The number that I've put in this chart reflects a fairly bullish, in terms of prices, expectation from it's the Rosario Grain Exchange number of about 37 million metric tons, which is about 1.35 billion bushels. That's a pretty small number. I think there's, that's on the sort of small side relative to the universe of estimates. Even with that number, we're going to see a rebound in South American soybean production. And that kind of overall suggests the prospect of the market needing to lower prices to ration supply.
Yeah.
What do you think, Scott?
I think the key number to really keep in mind is the green bar on the far right. Just ponder for a minute that the projection is a 5.6 billion bushel soybean crop alone in Brazil. So that if, let's say, Argentina is down 200 or 300 million bushels, I mean, you can just slightly better than expected conditions in Brazil will just totally offset that for the total South American supply. I mean, Brazil is such a giant. That's, more than 1 billion bushels larger than the U.S. crop now down in Brazil. And it's just so important to keep that in mind as you consider the potential market impact of any shortfalls in Argentina, which is, again, an important producer, but vastly smaller than Brazil.
I think the other part is sort of thinking about, we'll see a lot of weather news, and we've seen a lot of sort of negative weather news, particularly out of the southern part of Brazil and in through Argentina in the last few months. At the same time, that crop in that part of the world is not yet made. We will get more weather news, and we're just kind of coming into the prime growing season period, or so the key growing season period for weather. And so it is possible that these production estimates are, maybe, darker than what we might end up seeing.
Right. And there's, right now, the forecasts are kind of turning for those southern South America regions in Uruguay, southern Brazil, and to the heart of the Pampas in Argentina, to some pretty good rains in the next week or 10 days. And U.S. farmers know exactly what that is. I would liken that to we've had kind of a dry June, and we get a nice round of rains around the 4th of July. That's kind of what it looks like to me, timing-wise, that might be going on down there. It has to be verified and so on. And again, it's so critical to also emphasize, particularly for soybeans, we know that they can be pretty robust to some early dry conditions. And if we get later in the summer, some good rains. And that's a possible scenario that could be playing out down there. So just important to keep that in mind.
The other thing is that, that production number for Argentina, would be sort of a record low, a small crop, given what planted acreage is. And if we get some timely rains, you wouldn't want to sort of bet on the smallest ever crop. So
yeah, I think the perspective for particularly our farmer listeners is, there were a lot, not all, but there was quite a few farmers that were very pleasantly surprised with their corn and soybean yields in parts of the Western Corn Belt, and under some pretty dry conditions. So they have access to some of the same genetic technology that we do. And one more number I just thought, before we leave this slide, is over there on the left, is that Brazil is now about ready to harvest a 5 billion bushel corn crop, in addition to that 5.6 billion bushels soybean crop. So Brazil's has rapidly risen to their corn crops about a third of the size of the U.S. crop.
Right, and the implication there is, increased competition in export markets. We've seen
Absolutely.
The stories about Chinese imports of Brazilian corn, when historically, in the last decade, has not imported Brazilian corn at all. So it does kind of mean a little bit of headwinds on the demand side for the U.S. going forward. All right, with that, thinking about that story, I think will continue to play out in the next year. But as we sort of solidify our expectations for the South American crop, the other part is, what does the United States do? How do U.S. farmers respond to current price incentives? And for that, we kind of want to think about, well, what does the overall U.S. crop acreage picture look like? Scott, I'll pass it to you.
This just shows the blue is the principal crop acreage. That's all the major and minor crops in the United States, over 20 different crops dominated by corn, soybeans, and wheat acreage. And then prevented plant is acreage that is insured but did not get planted due to basically wet conditions in the spring largely. And you can see 2019, that was really large. So I like to think of this as the total acreage base that we can think about. That's been hovering since 2015, right around 320 million acres. We talked about this last year. I expected that number to go up in 2022. It did, but it was mainly due to larger prevent plant and not actual planted acreage. So I've been expecting that principal crop acreage number to go up fairly substantially for a couple of years, and it has not happened. So I want to put that out there, Joe. But I think the incentives are so substantial, it's still hard for me to see that we won't see that continue to tick up, and that we might get 3, 4, 5 million acres total added someplace in basically the Great Plains, Midwest, and South that have not been included in the planted acreage total figure. We'll see.
We'll see.
I'm a little cautious this spring after the last couple of years, but the economic incentives are there for more acreage.
They continue to be there, and the historical parallel is what happened kind of coming out of the last big price surge in 2012, 2013, 2014. We did see a slight uptick in that principal crop acreage number. And you have to, again, think that all of the incentives are there.
That's right. And, it did get as high in 14 as 325 million. And that was principal crop alone. So we'll see. My lean is that we're going to see that blue bar for the 2023 crop rebound up above maybe 320 million acres.
Then the next question is sort of how do we split up that pie? How do we divide it between crops? And really, this is in large part a decision of what's the mix between corn and soybeans. Going into planting a year ago, we saw the market sort of moving towards favoring corn. So this graph shows the soybean corn price ratio. We through 2021 sort of strongly favoring soybeans. From sort of fall 21 to spring of 22, moving towards corn as high fertilizer prices created a pretty strong incentive for farmers to plant a lot of beans in the face of high cost of production for corn, and the market recognizing that and moving prices to levels that would sort of maintain our significant corn production in the U.S. So that ratio sort of bottoms out in the spring of 2022. Since then, we've seen obviously fertilizer prices relaxed. If you want to talk about fertilizer prices, one of our upcoming IFES webinars with Gary Schnittke and Nick Paulson will talk a lot more about sort of what's happened in fertilizer markets and how that's affected farm profitability. But from a marketing standpoint, we've seen sort of grain markets move to a much more neutral stance in the last year. So if anything, sort of argues for a little bit of sort of long run status quo, if you will. I think that's the story that I tell here. The other part of that is if we did sort of skew maybe a little bit heavy towards soybeans last year, the incentives in terms of crop rotation mean that we're going to maybe move back in some way towards corn in 2023. We know that acreage response is a little bit more flexible in the short run than it is in the long run, just because of those crop rotation incentives, are pretty strong. We can only sort of skew heavy towards one crop for sort of a limited amount of time. With that, we move to the new crop corn balance sheet. Again, we're showing sort of an accounting of supply and use here. We show USDA's current old crop projections in the January WASDE. The third column here shows USDA's original projections for 2023-24 in their long run baseline that was produced in October. So that does kind of reflect both what the sort of the WASDE projections were from the previous year as of October. Notice in those numbers a pretty low number for beginning stocks. We do see USDA's current stocks number going into the 2023 marketing year, 23-24 marketing year, a little bit higher than that. So this is maybe a little bit tighter in some respects, at least baseline, but we do see some reason to maybe differ from those projections a little bit. The big top line numbers here are the acreage number. USDA projected at that time a 92 million acre planted area acreage number for corn, with typical abandonment that get harvested acres right around 84 million acres. Significant rebound from 2022. We see maybe a little bit of a reason to differ with some of those numbers. If anything, if our projections for acreage response are true, we might see corn acreage even a little bit higher than that. We've pegged planted acreage at 92.5 million acres. We do see yields rebounding. USDA's long run trend line yield is at 181.5, Scott. We see maybe not a full rebound from sort of low levels in 22, but a significant rebound back to a number right around 180 million bushels.
Exactly. We've never actually had a crop above 180 million yet. And so that I think the USDA is pretty aggressive on their trend yields.
Okay. The net impact of that is obviously, I mean, we're projecting slightly bigger acreage, slightly lower yield. That gets us to a total production number that is pretty similar to what USDA's long-run baseline projections were. The important thing to note here is it just is a pretty significant rebound in U.S. corn production. We're talking about something in the neighborhood of 1.5 billion bushels more corn produced in the United States in 2023 than in 2022. On the usage side, USDA's baseline was, I think, pretty aggressive in terms of what they projected for feed and residual use. We see that number being slightly lower. USDA at 5.7 billion bushels. Our number is 5.6 billion. Just in reflecting that it's hard to rebound project a rebound in use that large in that short amount of time. USDA's long-run ethanol numbers, we don't see much reason to dispute. But we do think that their export projections are perhaps slightly rosier than what we might think of going forward on the basis of weak export sales in 2022, 23, and also this Brazilian corn crop that's going to be harvested. That'll still hang over the market into the next marketing year. And so we project U.S. corn exports lower, substantially lower than what the number that was in that USDA baseline. For 2023, we project 2.1 billion bushels of U.S. corn exports. All that together means a substantial rebuilding of stocks back to a number above 2 billion bushels. And that's sort of a number that's been kind of talked about in the trade in the last few weeks. As we go forward, where do we get to? We're going to see a rebound in a rebuilding of supplies, absent some, massive weather shock. But how big is that supply rebound? Where does it get us to in terms of a final balance sheet number? We project stocks to use at 14.1% for the 2023-24 marketing year, and that's going to need to mean lower prices, Scott, to ration that what is a substantially weaker balance sheet.
In fact, the only point I would add is that at a 14.1% stocks to use ratio, 520 historically is still would be viewed as optimistic.
That's right. It does reflect coming out of maybe a year where we see still new crop prices in a high fives kind of number across the Corn Belt. That's I think based on these numbers, a marketing opportunity that, again, all of this being driven by supply response, higher production. We have to think that production in the U.S. will rebound in 22-23. Okay, on the soybean balance sheet, again, probably less reason to differ with USDA here. We project maybe slightly higher planted acreage, reflecting sort of the idea that acreage pie will grow a little bit. 88 million planted acres for soybeans in the U.S. in 23-24. Again, perhaps maybe slightly lower yield, but still sort of historically strong yields. Our yield projection at 51.5 million bushels. The thing to note is we do project that the carry-in for 23-24 is substantially lower. Again, as we talked about for reasons we talked about earlier. But that does get us to a pretty tight ending stocks number. We don't sort of see too much reason to differ with the domestic and export usage numbers from USDA, which are still sort of like not substantially above levels that we've seen in the last few years. That gets us to a pretty tight ending stocks number of just over 200 million bushels and an ending stocks to use ratio of 4.7%. We'd have to think that prices need to maintain some strength to ration supplies at that sort of in that kind of supply and demand picture with those levels of stocks. Any other thoughts, Scott?
No, I think it's tight.
And the last thing I want to talk a little bit about is sort of the overall macroeconomic situation. We do get a lot of questions about sort of what is this overall kind of macroeconomic cloud, the fears of global recession. What does that mean? The one thing that we have seen over the course of 2022 is a substantial increase in interest rates. The benchmark Fed funds rate up 4 percentage points from, we've seen over the last 10 years, so rock bottom interest rates, effective benchmark interest rates right just hovering above zero. I don't think that's a major driver of corn and soybean price levels going forward, but I think it does change how we market the crop. The thing that has moved in concert with that are interest rates faced by farmers. So the orange line here represents the average interest rate on new farm operating loans. And I kind of view that as a benchmark of the opportunity cost of capital at the farm level. We've seen that increase 2 percentage points over the course of 2022. That's an increase that we haven't seen at a rate that we haven't seen in a long time. And what that means is that every dollar on the farm holding, the cost of not using that dollar or of, say, deferring sales, not getting paid today and getting paid out in the future, that opportunity cost increases. And I think that has direct implications for grain marketing. Some of the research that we're doing right now that I'm working on here in the Department of ACE at the U of I just looks at what is the size of the marketing problem that we have at the turn going into a new calendar year. The one thing that we see in the data that we've looked at year after year is on December 31st at the year end, a substantial number of farms hold practically all of their production in inventory as of December 31st. So these data come from our FBFM, the Farm Business Farm Management Association. Farms who participate in that association, roughly a third to a half of those farms in any given year, and this repeats itself in the data year after year, hold all of their grain in inventory on December 31st. I know some of that is just sheer logistics. Some of that reflects income tax considerations and the need to defer sales from one tax year to another. But some of this does reflect old crop, unpriced grain that farmers have sitting in storage that they are not getting paid for today. And the question is sort of, well, what is the cost of sitting on this grain? And in a high interest rate environment, Scott, the cost of storage goes up. So this kind of gives you a short example based on current price levels, or at least price levels as of a few days ago. We've seen maybe a little bit of weakness, but I think the numbers largely hold in this case. At current cash prices, you could sell that old crop grain today for about $6.75 for corn and about $15.15 a bushel for soybean. If we're in an interest rate environment like we were a year ago, the cost of sitting on that grain is about 4.5% on an annualized basis. In the current environment, it's up to 6.5%. If we think about storing that grain over a 4-month storage period, a 4.5% interest rate says that the opportunity cost of sitting on that grain is about 10 cents per bushel for corn and 23 cents per bushel for soybeans. Interest rates move up 2 percentage points. The cost of sitting on that grain now increases by the same proportion. So instead of 10 cents for corn, it's now 15 cents. And for soybeans, with every bushel of soybeans being worth more, the opportunity cost of that income is correspondingly higher. So the opportunity cost of storage for soybeans is now 33 cents. With the current market structure, with sort of slight inverses in forward bids for corn, and maybe a little bit of carry in the soybean markets, the market is paying you a little bit to store those beans, but it's not anywhere close to enough to justify the opportunity cost, and in particular, not anywhere close to justifying it at a 6.5% interest rate. We're talking about significant losses from storing grain. I think the story here is just that in a high interest rate environment, the stakes for grain marketing kind of go up a little bit. The cost of waiting gets greater. And that's something I think farmers have to seriously think about as we move into 2023.
Great point.
All right. So with that, we'll just kind of walk through some summary comments. Again, on the old crop side, corn supply and demand balance corn and soybean demand, supply and demand balance, remains tight. We are at historically high price levels. We'll see the market continue to trade South American weather news, and that'll continue to produce some volatility. Again, in a high price environment is also a high volatility environment, and any news from that part of the world is going to potentially have significant impacts on price levels. There is some downside risk here due to weakness, particularly for corn and wheat exports. On the new crop side, market signals for corn and soybean planting are pretty neutral. I think we see a more significant rebound in corn acreage and production for 2023, again, because of the skew towards beans in 2022. And then we have hanging over all of this the prospects of a global recession. We haven't there's not really a lot of data that we can bring to this, but I think everything that I hear about the macroeconomic situation, Scott, suggests there's kind of this like resignation to that at some point we need to go through sort of some sort of recessionary period in sort of the global economy, and that typically means lower demand for commodities in general.
We just saw that retail sales in December came out this week down 1% for the U.S.
Right, and so that doesn't argue for sort of booming corn and soybean markets going forward. All right, the last thing again in terms of marketing decisions, how can farmers respond to this information? We can't change the price, but we can change how we respond to it. And I think the point to make here is that, again, high interest rates means higher stakes and a need to sort of make some cold calculations about grain marketing and the cost of waiting going forward. So with that, we'll move to questions. We do want to acknowledge our sponsors. I'll turn it over to Todd here to do that. Thank you for your attention.
You bet. You've got a moment or two to put some additional questions in for Scott Irwin and Joe Janzen. We'll go to the top of the hour or thereabouts. So if you've got questions, go ahead and type those in the box. It should be a gray box either on the left-hand side of the page or down at the bottom, one of the two. We would like to acknowledge a few of our partners. They include the FBFM, that's the Farm Business Farm Management crew here in the state of Illinois, along with Illinois Extension, and of course the Department of Agricultural and Consumer Economics. Those are the educational partners, those who help to sponsor the FarmDoc team and the webinars, in particular the website. If you've not been there, farmdocdaily.illinois.edu or farmdoc.illinois.edu, one of the other. These sponsors include the TIAA Center for Farmland Research, Compeer Financial, Corteva AgriSciences, Farm Credit Illinois, IFES Growmark, and the Illinois Soybean Association, along with the Illinois Corn Association. Thanks to our sponsors, of course. We'll put up another little item here for the upcoming webinars. Next week, we'll talk about budgets, and the following week, South America. Both of those should be fantastic updates. And then we'll wrap things up with the Farm Bill and the price of farmland. For the following 2 weeks, you're signed up for all of these already. And the whole team will get together on Thursday, the 23rd of February, for a final event. There are some questions that have been posted. I saw the first one that came in, and I thought I would be sure to ask this one, and that many people would be wondering if the two of you have taken into account the demand for green diesel and aviation fuels. I'm going to guess that is certainly the case, Scott.
Yes, indeed we have. And that comes through in the crush demand for soybeans is where that's expressed most directly. And that's why we're seeing growth in the crush demand for soybeans. I always want to point out that green diesel is also known as renewable diesel. And that's where the real growth is going on. There's a lot of discussion about aviation fuels or SAF or sustainable aviation fuels, but that's tiny production as right now. It may grow a lot in the future, but the real question is, with the renewable diesel plants that are being built, how much pressure is that going to create for veg oil and fats and oils markets in particular? There's some sharp disagreement on that front. The USDA has tended to be kind of conservative, thinking that there's global adjustments that can occur in terms of fats and oils. It certainly puts pressure But I guess I would be on the side that I think the USDA has done a pretty good job of incorporating those pressures into their balance sheets.
Yeah, I'd only add, and the point that I made, last week when we were on the road is, I think that story about the renewable diesel demand is something that again provides strength to the soybean market. I think that's why why we project strong prices remaining in 2023. This isn't going to be the kind of thing that shocks the soybean market and causes prices to rally, $1 in a week or something like that. This is just something that's providing a foundation for demand, a continued strong foundation for the soybean.
But I would say there's a really important point that we learned about when the EPA released their renewable volume obligation rulemaking in early December, I think. The exact date escapes me. I was shocked by the negative reaction out of the soybean oil market to those RVOs. So I think it's important we all understand that a pretty darn bullish scenario for renewable diesel production demand for soybean oil is already built into the marketplace. And it's, I think, susceptible to pull back on production capacity building plans and things like that.
All right. We got a question here about the ARC PLC decision, and obviously price levels being a big factor in that decision. I know Nick and Gary did talk a little bit about that in last week. I mean, the one thing to note there is, of course, that at current price levels, we don't really anticipate significant payments from the sort of commodity programs, Title I commodity programs under the Farm Bill, at least in the sort of next year to year and a half.
Yeah,
I think I would add to that. I would add to that Gary is likely to do a 5-minute farm doc on it, so it'll be on.
Yeah, so we will have a variety of written material, webinars, and tools available to help people with that decision.
Absolutely.
Somebody also asked about fertilizers and use in the United States and what the expectations might be for the spring. I'm wondering if either of you have any thoughts on that.
I mean, we have seen substantially relaxed fertilizer prices. Now, I think, and again, I think my colleague Nick Paulson will talk about this next week, so I don't want to steal his thunder too much. But I think the point that he made is that we're kind of adjusting to price levels that are still elevated, but in the face of high prices, maybe they don't seem quite as bad as they would have if you'd said $1,000 ton anhydrous prices a few years ago. This would be devastating, and now it sort of seems, oh, maybe that's not so expensive. And so I think that does argue for, and I think those sort of, again, the current high prices argue for sort of, a return to sort of whatever we call normal fertilizer use going forward.
I agree, and the shock of fears about availability that started up last March and April, and it's helping that natural gas around the world has not. Europe has basically had a pretty warm winter, and so the pressures on natural gas, which you need to make nitrogen fertilizer, are not quite as severe as we had feared. So I haven't heard much that there's going to be big problems with availability this spring.
Well, we've reached the top of the hour. Our thanks, of course, go to Joe Janzen and Scott Irwin, agricultural economists, for making the presentations today. Jim Baltz is behind the scenes and also in front. In particular, he helps to make sure that everything looks really great on your screen. Thanks for doing all that work. He'll also update the survey to us when you take it as you leave today. And the FarmDoc video sites on YouTube. That's at youtube.com at FarmDoc video. Of course, you can subscribe to it as well. You see that up on your page at this point. I hope you will join me on the Closing Market Report Commodity Week at willag.org on occasion if you can. And of course, we'll talk with you again here from the FarmDoc Daily Webinars next Thursday. You have a good day.